Bitcoin continues to build a price zone, which could be a sign of an accumulation. Meanwhile, the macroeconomic context continues to show signs of stagnation and even sparks of recession. In Bitcoin's weekly chart, we can see that after losing the incredibly important $34,900 zone, a bearish continuation movement was carried out. In the candlestick from May 9th to 15th, we even saw a strong volume input in addition to a large spike, which revealed buying interest. The following week, a similar movement was carried out, halting in 0.61 Fibonacci zone. Pay attention to Fibonacci's extension from March 2020 to November 2021. As mentioned in the previous analysis, between January and April, a price distribution took place, which is a sign of correction. Following the fall, a price construction was produced in zones with liquidity gaps, as occurred in the week from May 16th to May 20th. In the current week, the price is found in the $28,800 zone, drawing a bearish movement. In the same time frame, we must pay attention to the speed and direction of the 20-period moving average in regard to that of 100, as if they were to cross each other quickly and drastically, it could be a sign of bearishness. In the daily time frame, we can see this clear lateralization phase, and in our previous analysis, we had mentioned the small divergence carried out from May 9th to 12th, which initiated a bullish movement in the short term. But this once again was rejected when the incredibly important $31,000 zone was reached, returning to those lower parts of this accumulation zone. On May 25th, a doji candlestick formed. Given it forms a shooting star candlestick as well as an almost full-bodied bearish candlestick that nearly covers the previous candlestick, although this one displayed a significant rejection. But let's not forget that the price's movement is in charge. Therefore, if a bullish movement nearly covers the previous body's candlestick, that candlestick pattern would be invalidated. The trend line points towards these lower highs, which is a sign of the price's weakness, to which we must add the volume decrease. And although between May 9th and 18th that divergence took place, in order to gain value, they must be more pronounced as well as mark oversold zones. If you take a look, the price displays lower lows and the RSI marks higher lows. This evident divergence is not quite strong. If we see candlesticks crossing the previous lows and the RSI remains above 25 points, the divergence would be more relevant. Now we can see a falling wedge pattern is starting to form in this lower trend. This pattern tends to have a greater chance of a bullish movement. But when looking at the entire structure, it could be considered as a pattern with continuation connotations, forming a descending triangle pattern or even a bearish flag. If it were to head toward the upside, we'd see the higher part of the channel being tested, accompanied by a volume entry that could surpass the previous volume average with harmony between effort and outcome, and the price would lead toward the $31,000 zone. Now, if we take a closer look, the higher part of the channel is also found in a zone that converges with the 20-period moving average, which would be quite an important resistance to overcome if it were to continue its upward movement. In this case, if the price were to gravitate towards the $31,000 zone, a parallel channel could form between $28,000 and $31,000. This could lead us to think about the continuation pattern mentioned recently. But the price could go on to test the lower part of the channel where the RSI would cross the 34-point zone and look for a bottom. In that inferior part of the channel, the price could hold still, according to the market strength as well as the volume input. If it crosses it on the downside, it could once again lead to the zone between $25,000 and $26,000, a zone which it had already approached on May 12th with a great spike. The candlestick on May 26th is a hanging man candlestick, although its connotations are a dragonfly doji candlestick, which in the lower part of the support zone tends to be a bullish sign. With the mixed oscillator, we can see that the stochastic RSI touches a superior part, which indicates overselling, and we can see how in the short term from yesterday to today, it needed a kind of correction to gain strength and continue its bullish movement. This was also indicated by a crossover in the wave trend. In the short term, the previous crossover served as a sign of bullishness, but yesterday they once again crossed each other. But watch out, as it could simply mean a break and could form a new mountain converging with the RSI while it extends the RSI's divergence. This would therefore be a sign of the most relevant oscillation indicators. In this heat map, we can see a great amount of USDT token limit orders in the spot market, precisely 2,200 orders in the $28,000 zone. We can even see a potential rebound zone between $28,000 and $28,600 due to the orders in the order books, which are produced by discretional traders as well as traders that use bots as part of their algorithmic strategies. In the inferior part of the chart, we can see long and short liquidations. Yesterday, we saw those liquidations marking a great spike in the price. We can see the total volume in red and green, and below that we can see a delta that indicates the difference between buying and selling. These lines highlight the accumulation of those delta in the volume, which provides the directionality in regards to volume in real time. And when that zone is reached, a bullish directionality is revealed. Green indicates spot, while blue indicates futures. We can see that both are heading towards the upside, but they now take a bearish turn, which could be a sign of a search for enough liquidity to bounce back and continue its bullish route. And in this heat map, we can see how it heads towards the important liquidity zone, as we can see in red, and we can also see that liquidity zone in the superior part of the shorts. But now let's move on to traditional markets to get a better understanding of Bitcoin's movements. In the daily SP 500 futures chart, we can see a divergence between May 12th and 9th. On the 12th, a hammer candlestick formed, heading towards the upside, and when the 4,100 zone was reached, we saw an engulfing candlestick rejection. Later, we saw a classic doji candlestick on May 21st, but then we saw a dragonfly candlestick, which in an inferior part tends to be bullish in nature. The price broke the 4,000 point resistance and has gone on to cross the 20-period moving average and close above it, aiming to head once again towards the 4,100 point resistance. This bullish movement is a result of the Federal Reserve, which we'll be discussing shortly. And now, as usual, let's analyze the macroeconomic landscape, given it has a direct impact on the cryptocurrency market. The macroeconomic situation is impacting the dollar. DXY is the index that compares the dollar with some of the most important currencies in the world. Last week, it reached a zone of highs at 103 points, although it has remained in a fake-out due to the macroeconomics data weakness and the declaration of Christine Lagarde around the Central European Bank's position in regards to interest rates and monetary stimuli. The president of the Central European Bank assures that the purchase of emergency programs due to the pandemic will soon come to an end. In addition, Lagarde seems more drastic than usual as she reveals that the rise in interest rates will kick off in July in order to contain inflation. And in regards to cryptocurrencies, Christine Lagarde believes that they have no value and requests regulations to protect investors. On the other hand, she confirms that the Eurozone is not heading towards a recession despite the rise in interest rates. Now, let's move on to the United States. The Federal Reserve minutes of the meeting on May 3rd and 4th published this Wednesday indicates that all politicians responsible support the 50 basis points increase approved by the committee. This 0.5 percentage point increase in its next couple of meetings starting next month matches expectations, and the market has already discounted this rise in interest rates, which explains the SP 500 boost. Let's not forget that investors aren't a fan of uncertainty and tend to react positively to news that is foreseen. Furthermore, the Fed largely rules out a more hawkish stance and opens up the possibility of a pause in rate hikes after the planned hikes in June and July. Now, let's move on to the gross domestic product of the United States, which is a wider indicator that measures the activity and economic health of the country. The first quarter of 2022 was worse than expected and sat at minus 1.5%, which indicates the economic contraction in the United States. If we continue to see negative rates over the next quarter, we'd technically be talking about a recession. And requests for unemployment benefits, as seen in this document, have decreased this week by 8,000 in compared to the previous week. It is a slightly better figure than expected, which means it is good news, although they're very volatile figures given they are offered on a weekly basis. In US Treasury bonds, we can see that profitability has increased up until November 2018. And let's not forget that if these yields increase, it would be a result of many bonds being sold, even though the Fed has still not reduced its balance. If the Fed sells a large amount of bonds in possession, profitability could increase to a great extent and intervention would be required, given if there's no backing to pay that debt, it could lead to an even greater deficit and potentially a government insolvency problem. In short, if the United States continues to experience a negative GDP and unemployment benefit requests increase, it could lead to the American economy's health being questioned, and the Fed could switch its focus, becoming more prudent in regards to the rise in interest rates and requiring more of an effort to balance out the price of the money and economic growth. In fact, in the case of a recession, tax collections would fall and therefore increase the risk of insolvency of the government's debt. That said, now let's move on to the cryptocurrency market. The overall market sentiment remains in a state of fear, as seen in this indicator. Bitcoin's balance in exchanges stepped back slightly until May 16th, but has recovered and now sits at 2.5 billion. This could be a negative sign, as Bitcoins are usually deposited in exchanges to liquidate them. And in this chart, we can see the entry and exit of Bitcoins from exchange accounts. Taking a closer look, we can see an accumulation of Bitcoins, which could confirm a selling downtrend. Although it is worth noting that this data can not only reflect Bitcoins sent to be sold, but also Bitcoins bought and held in exchanges. And an accumulation could occur due to the fear of prices continuing to fall. This already happened in June 2021, as many Bitcoins were accumulated in exchanges due to panic around the drop. Now, if we take a look into the perpetual futures funding rate, we can see that in May, investors are leveraged in shorts and were liquidated by bullish movements on May 12th. And take a look at what happened that day, on May 12th. Many long as well as short positions were liquidated, and once done, they once again positioned themselves in long positions. Now, they're not found in an over-leveraged zone, and we can see how once again they are heading towards the upside, which could cause another sale of long, which leads to those boosts. And investment funds have been accumulating Bitcoins since the beginning of May. And since the 17th of this month, they've been reducing their positions together with the fall of the price, which isn't ideal for Bitcoin's recovery. We'll have to see whether Bitcoin manages to remain in this range over the coming days and continues to carry out a price construction, confirming that this is an accumulation zone, or on the contrary, whether we're in a distribution phase. In the macroeconomic context, we'll be following the Fed and the Central European Bank's movements very closely in the face of the risk of a recession and the worrying inflation data.